Good morning, John. We're recording this on Thursday morning, and overnight, two interesting bits of information released. The first was NVIDIA's results. I don't know if you're going to have any comment about that, but the expectations were huge, and turns out the expectations were exceeded. NVIDIA recorded $28 billion in revenue for the quarter. Pretty astonishing. And the other bit of news was that BHP has further extended its bid for Anglo American. I think it started off bidding about 48 or $49 billion. Now it's up to about 78 billion. Before we get on to other matters, John, any comments about either of those two bits of news?
I think NVIDIA, you know more than me, Paul, but on BHP, we're watching it. I've talked to Will and the analysts about, BHP paying too much, and we know cycles, Paul. You and I, the reason we have no hair is we've been around a long time, and we've seen past resource cycles where major companies have done M&As at the wrong time in the cycle and have brought in current metals and commodity prices into evaluation and got it wrong when the cycle turned down, so they've paid top dollar. So, look, there's a lot going on in the metals market, as you keep on saying, Paul. So, but a mega merger like that will probably put a cap on the stock. So, and it'll bring in all the arbitrages. So, I'm almost hoping that the bid fails, but let's see what happens.
Yeah, John. Last week the big news was obviously the budget. You've had time to consider. I know that you've been writing a report on it. Any comments that you'd care to make on reflection about the budget?
Yeah, so there is a detailed report coming next week in the View. So next week, watch out for that. And I'll be presenting next week in Brisbane on it and going around Australia. But look, the budget was it's just work in progress. I mean, a lot of the announcements are continually made by governments these days. The budgets aren't really a bigger impact as they were in the past. The only real new news, which wasn't known, was the energy rebate. And my comment about that is very late. It should have been done a year ago. And look, I take the point that it's gone everywhere, but I just wonder why they couldn't have increased it for low-income earners, and particularly before the next Fair Work Commission discussion coming up in July. So I think if they're giving $300 to everyone, they could have topped it up to between $750 and $1,000 for anyone earning less than $60,000, and that would have been significant, and it wouldn't have had a big impact on the budget, frankly. Might have added another $1 billion to it. I also, in my report, suggest that the forecast deficit is probably wrong. Iron ore's jumped again to over $120 as we speak, so this year's surplus will be higher, and there's no indication that iron ore is going to dip. I did have a look at the China property market. There's quite some good charts which I've republished in the View. I think the outlook for iron ore, based on what China's gone through, and the announcement recently of they're buying a lot of property out of the market, so vacant property and property for sale, they're going to convert that to social housing. That probably 12 and 18 months away is going to be quite a good stimulation to the housing sector of China, and that's good for Australia. So I think the budget is conservative. That's my answer there.
Yeah. It's interesting. We had seen a very strong iron ore price, as you say. Copper as well had a huge run to unprecedented levels. Overnight, gold and copper have sold off a bit of profit taking there perhaps. But as you say, the importance of China dealing with their problematic property sector is very important to Australia. Can you just delve a little bit deeper into what it means? I mean, China remains by far our most important trading partner. And are there implications for the Australian dollar there?
Well, the Chinese economy, as I say in the report, and it's clear from Treasury numbers, like incremental growth coming out of China for world growth, China represents 25%. of incremental growth. Now, the robustness of the China economy, I keep on saying this, that the Western commentators talk about a slowdown in China. It's not going backwards, it's just growing at a slower rate. And I think dealing with the property market will put it back on track for that 4 to 5% growth for the foreseeable future, which means all the demand across commodities, bulk and metals will continue. And I guess that's another tailwind for copper. But Australia's major exports look fairly secure, and in the budget papers, just going back to that, there is quite a significant forecast deterioration in our terms of trade forecast for FY26. And I mean, to me, that's just fudging. That's just saying, well, look, worst case scenario, let's put this in, and if it gets better, we claim success. So the point about China is it's very important to world growth. World growth is important to Australia in export markets. So it's not only China demand. So if China's growing, the world grows. But specifically, China's growth is very important for our exports. As you say, 35% of our exports go to China. If they can stabilise the property market, get confidence back in the household sector, because it's had a knock-on effect to consumption, everything starts working again for Australia's benefit. My final point, Paul, is last night you commented that copper prices and gold came back a bit, iron ore was strong. The Australian dollar, which looked like it was surging, has pulled back again last night, and now we're stuck in the 66 cent level. And I continue to maintain it's very hard for Australian currency to break out against the US dollar while our industry funds continue to put more and more money offshore. They're constantly selling the Australian dollar, and the Australian dollar is not reflecting the inherent value in the Australian economy.
Just turning to the Australian economy at the moment, things are pretty slow and pretty soft to my mind. And I noted that Telstra has retrenched something like 10% of its staff. Are you seeing the Australian economy underperforming our peer group, just in terms of perhaps the per capita GDP growth seems very low?
It is. And again, when you delve into Treasury numbers, and what I do in my report is I take the charts and ignore what Treasury says. I think that's the way to approach the budget. Australia's growth, when you pre-inflation, so inflation growth, when you look at Australia, we've grown the economy almost 30% over the last 4.5 years, and that seems extraordinary. But 80% of it, or 70% of it's inflation, and the other the bulk of the rest is population growth. Real growth is very, very low. The other factor is real wages took a real hit coming out of COVID when inflation surged. Wages fell below the cost of living by 4 and 5% for 2 years in a row, and now we've got the catch up. So the wage increases are now catching up, and they're not catching up quick enough to that inflation surge. And because prices aren't really coming down, they're sort of stabilising, but they're not coming down. And that's why it was important that the government pushed down electricity prices, because that's one factor which may bring prices down and the cost of doing business. Until prices stabilise and come down, real wages on a 3-year look back are negative. And that flows into consumption. A dollar buys less than it did 3 years ago. That's the effect of real wages falling. The offset, as I said, is being population growth through immigration. But the other thing that jumps out is that Australia is not populating naturally. Our birth rate is declining, as it is across the Western world. And that's a function of the cost of living, Paul. The cost of living is too high to bring up a family. All the costs which were probably free for use, government supplied 30, 40 years ago, are now private. Childcare, a lot of the education services are now moving into university. Kids can't leave home. Parents can't afford to educate their kids and bring them up the way they want without two parents working. That drives a demand for childcare. There's, the costs go flying up there. It is really, when you think about it, quite a mess, Paul. And everything you say about it looks quite dull at present, or quite weak. It's all a function of very poor management of the economy. I can't stop reiterating that. we really need to get away from this nonsense going on in Parliament where black and white, yes and no, to consensus about how to drive economic growth, and it's well overdue.
John, I know that central banks have been looking for the so-called soft landing, and one of the targets that they're looking for is a reduction in the tight labour markets, looking for perhaps unemployment to start with a 4-figure instead of a 3-figure. And they've seen that in Australia. We're seeing unemployment ticking up. We're seeing unemployment in the US ticking up as well. Presumably, this allows the central banks to think about reducing rates. If things are as weak as you're suggesting in Australia, is this going to come sooner rather than later? And so if we're thinking to the end of 2024, do you think interest rates are going to fall, the Australian dollar is going to rise, and we're going to be in a slow patch? How do you see it between now and the end of the year?
Well, we're stuck, Paul. I mean, the Central Bank of Australia is holding interest rates 1.25% below America and slightly above Europe. We really can't do anything on the interest rates until America moves substantially. In America overnight, again, statements coming out of various members of the Federal Reserve saying that they're disappointed with the trends in inflation and indicating that interest rates aren't going to fall anytime soon in America, which puts us in a holding pattern, and it allows some of the hawks, the Australians, some of those economists who like listening to themselves, saying, well, interest rates can go up in Australia. The only reason you put interest rates up in Australia, Paul, is to try and get the Aussie dollar up to get imported inflation down. We are precarious. Our currency is undervalued. Hence, we are importing inflation. The good news is that inflation readings coming out of China are very low. So there's some of those consumer goods. But as you know, in the last decade, we have moved our supply of electronics and white goods, more to broader Asia than China. So the benefits of low inflation in China aren't coming through. So I just see interest rates staying where they are until further notice.
Okay.
At this stage, the household sector is just dragging through. Those who with debt, got less money to spend. Those not in debt, keep on consuming. And the big question is, what will immigration do, Paul? And that's the debate now. And a lot of focus on students. I think there should be more focus on non-students rather than students, frankly. I think we're missing the point there. A much more focused immigration policy meeting the needs of Australia is what's needed.
Time for one last question, but it'll have to be short. I mentioned Nvidia because, the mega tech stocks in the US have really been driving, massive earnings growth. Here in Australia, when we look at our market, apart from, the commodity exporters, hasn't really been much earnings growth. Do you see the Australian share market as still offering attractive places to invest, or, is it all offshore?
Well, you diversify your equity exposure, and depending on your risk profile, which is a discussion you have with your advisor, you certainly, depending on, again, it's all about where you are in life, but certainly if you're younger and can take on more risk, you can allocate more to international and match it out with Australia. So if you were saying 50-60% in equities, it might be 30-30, but it really depends on the individual. But Australia is a yield market. It's not a high growth market. The stocks presented on the stock market, as we're seeing with Telstra, you comment earlier, cutting staff. I mean, some of the big companies are struggling, but we've also got to be aware there was a free kick to a lot of Australian companies as prices went up. So some of the earnings were brought forward, and then as wages go up, those margins are cut. So you're probably right. I'd say this 12 months period we're in, as wages catch up, and those companies which have high labour forces will find it difficult, I think, in this environment to pass on price increases further in this environment. So there could be some margin compression which may affect some companies. So watch this space. It's up to our analysts, and I think we'll we'll be looking
Yeah.
at that. So more outward-looking companies rather than inward-looking companies is what you want to put into your portfolio at present.
Yeah, yeah, and I must say, Will has been pretty encouraging that the investment team and the analysts are on the ball, and they're seeing quite a few opportunities to buy pretty attractive companies at current prices. So I think that's all good. Anyway, John, that's all we have time for. Great speaking to you, and thank you very much. And next week we'll be distributing your comment on the budget. That's great.
Yeah.
Thank you.
And hopefully I get to see as many people as possible in the next 3 or 4 weeks as I travel around Australia. So look on our website for those meetings and book in.
Good stuff. Thanks, John.
See ya.
Cheers.
Bye.